Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. In today's topic, we're taking a look at two big tech stocks that help kick off the tech portion of earnings season next week, and that is Netflix and Taiwan Semiconductor, to see if they're worth buying ahead of those earnings reports or possibly after those earnings reports. But before we get everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. So before we jump into Taiwan Semi and Netflix, I want to just quickly go over a little bit of where the market stands as I'm recording this on Thursday afternoon, right before the start of earnings season on Friday, with the big banks helping kick off Q2 earnings season. So Jay Powell finally appeared to turn a bit dovish this week. The Fed boss has seemingly been swayed by an array of economic data that he now is convinced that the central bank has done really all it can on the stable price side of its dual mandate, and now is not going to wait for something to break before cutting rates. So Powell's hoping they're going to be able to pull off that much hyped and kind of hard to achieve soft landing. And we saw kind of all of this lead to a big run up on Wednesday to new all-time highs for the NASDAQ and the S&P 500. And it just seemed like some profit taking was due. And sure enough, as I record this on Thursday afternoon, the NASDAQ's down about 2.1%, and the S&P 500 is down about 1%. The NASDAQ and the S&P 500 had just gotten really extended over their 21-day and 21-week moving averages and at super overbought RSI levels in the near term. So there was always going to be a pullback. And so on Thursday, we're seeing a little bit of maybe sell the news as the June inflation data came in below expectations. So in the next several days and weeks, it's possibly you're going to see some more profit taking, which is healthy. It's a good recalibration. So this isn't a bearish sign. The bulls still have earnings growth at their back and the likelihood of rate cuts very soon to drive the market. Now, it will be then a question of if the earnings estimates come in significantly lower for big tech in the coming weeks, we could see maybe a larger pullback. But overall, the bulls are still in charge. So with that backdrop, don't be too nervous about any near-term profit taking. And any near-term profit taking on some of your favorite tech stocks and those best-in-class names might be used as a chance to buy them at a slightly lower price and valuation. So with that in mind, we're taking a look at two big tech stocks that fell on Thursday, along with a lot of big tech that in the coming days and weeks might fall, depending on how the market reacts just to the broader earnings cycle. And that is Taiwan Semiconductor, better known as Taiwan Semi or TSMC, but the ticker is TSM. They're going to report their Q2 2024 results on Thursday, July 18th. So Taiwan Semi is the largest and most dominant chip manufacturer in the world. Its foundries physically build the most cutting-edge semiconductors that drive AI, smartphones, and nearly every other advanced technology. It boasts clients such as NVIDIA and Apple. In the firm's driving forward 5-nanometer production, and it's rolling out quickly its next generation 3-nanometer chips. In Q1 of 2024, it said that 3-nanometer accounted for 9% of total wafer revenue, with 5-nanometer accounting for about 37%. And that 3-nanometer percentage was up from the fourth quarter of 2023. Taiwan Semi is reaping the rewards of its founding principle, which is manufacturing chips only. Its moat is massive and growing, considering just the institutional know-how and the enormous costs involved in physically building the most difficult thing to build in the world, at least one of which is advanced semiconductors. It's one of the only pure play chip manufacturing stocks, and it's actively expanding outside of Taiwan, given the geopolitical tensions with China. Even though it's facing some near-term construction setbacks, given the complexity of the task, as we just said, it's building huge semiconductor plants in the United States, spurred by incentives. Then in February, it actually opened its first majority-owned subsidiary in Japan, which they're calling Japan Advanced Semiconductor Manufacturing. And then in April, Taiwan Semiconductor, the news broke that it's getting up to $6.6 billion from the U.S. government for a factory under construction in Phoenix. So it's just going to try to roll out more factories in the United States, as I alluded to already. And that's being boosted by a big internal push from the United States to manufacture these cutting edge chips in the United States, as I said, with those geopolitical tensions in China. So overall, the U.S. share of chip manufacturing fell to 12% in 2020 from 37% back in 1990. So the United States is trying to have that number start trending heavily back upwards in the next decade plus. So overall, TSMC, the U.S. is on track to make about 20% of the world's cutting-edge chips by 2030. That's the goal, and TSMC is going to be a big part of that. The company averaged roughly 18% revenue growth between FY 2018 and 2022, including 29% growth in 2022. And then it had a bit of a cyclical downturn in 2023, but it's heading back in the right direction, and Wall Street's been looking ahead to return to that big double-digit growth this year. So the company most recently reported its Q2, well, I shouldn't say Q2 as a whole, but it does month-by-month revenue reports. So then obviously Wall Street can combine all of those. So it already has topped Q2 revenue estimates. It reported that earlier this week. So overall, Zacks is calling for about 29% revenue growth in the second quarter and overall 22% full year revenue growth to go from about 69 billion to about 85 billion, and then another 21% growth next year to get all the way up to 103 billion on the top line. And then on the bottom line, we're calling for about 18% adjusted earnings growth in the second quarter, 18% growth for the full year, and then a 27% jump on the bottom line in 2025. So really impressive double-digit 20%, 21% growth this year, 21% growth next year on the top line, and then 18 and 27% respective bottom line growth is what we're calling for Taiwan Semi. Overall, its earnings outlook for 2025 has improved about 10% over the last year, which is a significant jump, with its outlook for 2024 up about 5% over the last year. And its most accurate / recent earnings per share estimates have come in slightly above the already improved consensus for 2024 and 2025, with 2024's most recent estimate up about 5% above consensus, which is a nice, solid thing to see there heading into its earnings release next week. And Taiwan Semiconductor, given that improving earnings outlook, lands a Zacks rank number 2 buy. And then in terms of its price performance, the stock has doubled the tech sector over the last 10 years. It's up about 700% versus 350% for the tech sector. It had been underperforming until it finally started to break out again in 2024. It finally broke out to new all-time highs in March, and it hasn't really looked back since then. The stock's up about 75% year to date and around 30% in the last 3 months. And as I alluded to, Taiwan Semi did dip alongside most of the tech sector on Thursday, and it could drop back down to its 21-day or 50-day moving averages in the coming days or weeks. Its 21-week moving average currently sits at around $154 per share, versus the last time we looked, it's trading at around $184 per share right now. So if it does pull back all the way down to that longer-term 21-week moving average, that would, in my opinion, be a screaming buy if you're a long-term investor. It is a little overheated at the moment. It's trading at some heavily overbought RSI levels and way above that 21-week moving average. So there will be some near-term profit taking. The pressure, it will be on. These stocks just cannot ride way above those moving averages for too long without some recalibration. So if you want to possibly wait for a pullback, certainly worth considering. But if you're a longer term investor, maybe you don't need to get too greedy and try to time things exactly. And then on the valuation front, Taiwan Semi is trading at a 7% discount to the tech sector, despite that long-term outperformance, trading at 27.5 times forward 12-month earnings, and roughly 20% below its own 10-year high. So its valuation is still really solid. The company also pays a dividend. It's yielding about 0.9% at the moment, so nothing spectacular, but an impressive boost for a company that's at the cutting edge of one of the most important parts of the economy now and for years and years and decades to come. It has a strong balance sheet, and 8 of the 10 brokerage recommendations that Zacks has are strong buys. And overall, it stands to benefit from the continuation of just how important semiconductors are to the entire economy, especially then as we roll into this AI revolution that everyone is so excited about. And then in full disclosure, I do own Taiwan Semiconductor stock personally. And now we're going to move on to another company that reports its Q2 results on Thursday, July 18th, as I said, kind of kicking off a wave of big tech earnings next week. And that is Netflix, which trades in the ticker NFLX. Netflix, as most people know, it's much more of a household name than Taiwan Semiconductor. Really changed entertainment industry forever, altering the way people watch movies and TV shows and really the entire entertainment landscape for, you could say, the better or worse, depending on how you like watching TV. But its vanguard status and growing content library has helped it maintain that edge over Disney and Apple and Amazon and all of the countless other streamers, because every big company is now going all in on all in on streaming. And that said, though, the stock did get crushed at one point for slowing top line expansion and fears that growing competition would eat away at its market share and just kind of maybe make Netflix much less relevant to people. But it's addressed all of those anxieties, and it crushed its membership estimates throughout 2023 and in the first quarter of 2024. Its lower cost ad-based tier is gaining a ton of traction. It's expanding into video games. It's worked heavily on cutting back account sharing, so that's helping subscriber growth. It's doing a lot more live streaming events. It's getting into the sports world, which is kind of the big front for streaming. That's where all the big players are vying for now, are these live rights to sporting events, because that is where all the ad money is left. I mean, no one needs to watch anything else live besides sporting in terms of television mostly. They have a 10-year deal now with the WWE that's going to bring some shows to Netflix. The company is set to live stream actually 2 NFL Christmas Day games this year, which is a big deal. They're going to do many other live streaming events. They're also catching fire with a lot of their reality TV programming. And as I said, this live program is going to be a next big frontier. So overall, if we look at some subscriber figures, the company added over 13 million net paid subscribers, and this is back in the fourth quarter of 2023, which was 50% more than Wall Street had projected. Better yet, it was actually the company's most ever added subscribers in a single quarter outside of the first quarter of 2020, when the COVID outbreak happened, where everyone then just decided they were going to sit at home and they had to watch TV. Netflix actually added more subscribers on its own than Wall Street had predicted for Netflix, Disney, and Warner Brothers altogether. Then last quarter, the first quarter of 2024, it added about 9.3 million net new subscribers, which also crushed estimates for Wall Street, which were at about 5.1 million. So back-to-back quarters of huge beats in terms of subscriber growth. Netflix did note that its ad-based membership increased 65% sequentially, accounting for about 40% of all signups in countries where that offering was there. However, it is worth noting that Netflix did kind of shock Wall Street last quarter when it said it plans to stop providing quarterly membership data and average revenue generated per member. The company had previously stopped providing guidance for subscriber growth, but now they're just going to not provide quarterly subscriber figures. And that's going to be starting in 2025, in the first quarter of 2025. So over the next several quarters, we're still going to get that figure. But the company said it will still announce what it calls, quote, major subscriber milestones. So when they get to big figures, when they were asked about the decision to stop doing that on their earnings call, their co-CEO said the change was motivated by wanting to focus more on what he called key metrics that we think matter most. This includes operating income, earnings per share, margins, free cash flow. They think that it's a better approach that reflects the evolution of their business and is more consistent with how they're managing things internally. So the company closed last quarter with just under 100 or 270 million global subscribers, which was up 16% year over year. So that's where they sit at the moment. And maybe they'll then say when they get to, I don't know, 280 or I should say, because they're going to still report in the near term what their subscriber figures are going to be. But then starting in the first quarter of 2025, they're going to stop. So maybe when they get to 300 or things like that, they're going to say. how many members they have. So now Wall Street's going to be more focused on that bottom line growth, free cash flow growth, and then revenue growth as well. So with that in mind, we're calling for 15% revenue growth this year in 2024, and then another 12% revenue growth this year or next year to go from about $34 billion in 2023 to $43 billion in 2025. And then on the bottom line, we're calling for 52% adjusted earnings growth this year, and then another 21% adjusted earnings growth next year. So impressive bottom line growth. And in terms of estimate revisions, its 2024 earnings per share estimate is up 18% over last year, and its 2025 estimates also up roughly 18%. So some solid bottom line revisions. That said, it's stagnated recently, helping it land a Zacks ranked number 3 hold in terms of those revisions. They've kind of just flatlined over the last several months. And then in terms of stock performance, Netflix stock is up about 933% over the last 10 years, blowing away tech, which is up 350%. And this run is even more staggering if you go back over the last 15 years. The stock's up around 275% off its 2022 lows, but it did get rejected from breaking new highs, all-time highs recently. So it got right back up to those 2021 peaks and then got rejected there. Its 21-week moving average is down at $630 per share. Its 50-week moving average is down at $530 per share. It's currently trading at around $648 per share. So if it does go down to those levels, those could be some levels to look out for if you're a longer-term investor. This is totally speculative. It could be a stock that might join the stock splitting camp at some point soon. As I said, it's trading at almost $650 per share. So that could be something to keep an eye out for as well. It's also trading, though, at a 90% discount to its highs in terms of forward earnings, which is a great sign, at 34.3 times forward 12-month earnings. And that's 50% below its 10-year median as well, and not too far above tech, which is trading at about 29.5 times forward 12-month earnings. So it's trading just below its all-time highs. It did get rejected from breaking out to a new level, but in the coming weeks and months, it certainly wouldn't be shocking to see Netflix finally break back above to all-time highs and continue on from there, considering just how important their business is and how prepared they are to really excel in the new world of entertainment now and for years and possibly decades to come. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.